Good morning, friends. Greetings from Sushil Agarwal and IFA India NRC. IFA is pleased to host today its webinar named Foreign Tax Credit, Intricacies and Practical Aspects. Well, friends, before we talk about FTC, I think what first comes to my mind is the amendment in the Finance Act 2020, uh, which for the first time brought in the rules for citizenship-based residence. So a person would be treated as a resident in India if he is uh, not taxable in any other country. So he would become taxable in India because he is a citizen of India. And of course, he has to have income exceeding 15 lakhs. Now, these type of provisions, what was the need to bring in? They were brought in to avoid double non-taxation. So, as the provisions get stringent like this, what happens is double taxation becomes a very normal phenomena. Now, double taxation would arise mainly when the source countries taxing income and the residence country is also taxing an income. So when both of them are taxing, there could be a conflict of source, a conflict of residence, or there could be both a source and residence conflict. When both of them are taxing, then what happens? The DTA comes into play, and DTA tries to define and restrict each country's right to tax a particular income on a particular person. Now, when DTAs are to be evaluated, things get a little more complicated because the issues do not remain restricted to uh, taxation of a particular income. It becomes also important to identify uh, which particular income is taxable in which country, on which particular tax is to be available for the purpose of foreign tax credit. Now, normally DTA provides two ways of giving you relief. Either it is an exemption of income or it is a foreign tax credit. When it comes to foreign tax credit, then you have to see which tax is available for credit. So we have taxes like dividend distribution tax, where the controversy arises as to whether it is a tax on the payer of the dividend or it is a tax on the recipient of the income. So the question of putting it, giving you a foreign tax credit for a dividend distribution tax, what first needs to be determined whether it is a tax on the person receiving the dividend or it is a tax on the person paying the dividend. So there would be number of such controversies. Then there would be period related, assessment year related issues in defining in which period the income is to be taxed. There would be income would be treated differently in different countries. So uh, as we start going into the process of uh, foreign tax credit identification, the mystery becomes deeper and larger. So it cannot be handled in a stereotype manner. And so today, in order to clarify on this mystery, IFA has brought to you a very important subject, intricacies and practical aspects of foreign tax credit. And friends, I am pleased to tell you today we have a very fiery speaker uh, on this subject, Monika Wadhani. So before I hand over to Smita and Monica to take the proceedings further, let me have this opportunity to introduce IFA to you, because I understand there are members who are not IFA members at present. They are persons who are joining as non-IFA members also. So International Fiscal Association is a leading international NGO on tax matters. Established in 1938, IFA is a neutral and independent platform discussing international tax issues. World over, its members comprise corporates, tax professionals, government officials, jurists, academicians. Headquartered in Netherlands, it has over 12,000 members worldwide. IFA India branch was set up in 1983 and has more than 400 elite members and expanding. So uh, I invite you all to a wonderful session from Monika Wadhani and over to Smita. Thank you very much.
Thank you, sir. A very good morning to all of you. I welcome you all on this virtual platform on behalf of IFA NRC. So just to give you a formal introduction of our speaker, Ms. Monika Wadhani is a technical director with KPMG. She has a vast experience of more than 16 and a half years with KPMG member firms. She has advised various multinationals on a variety of tax and regulatory matters with a special focus from international taxation, exchange control, and company law perspective. She is a member of International Tax Committee on BCAS and CTC and convener of BEPS Study Circle of BCAS and International Tax Study Circle of CTC. She has done in-depth study of BEPS action reports and MLI and has contributed a chapter on overview of MLI and each of its 17 articles, part of MLI compendium published by BCS. She has also contributed a chapter on MFN clause, part of its CTC's latest international tax compendium. She has written various other papers and articles on tax and regulatory issues and is a regular faculty at various forums like ICI, ICSI, BCS, CTC, IFA, etc. So now I hand it over to Monika. Monika, one question. Would you like to take up Q&A at the end, or do you like to take up during the session so that we can...
What we can do is that we can have Q&A at the end of each case studies. I have more than 5 case studies, and what we are going to do today, everyone, is that we will discuss the basic aspects in nutshell. Thereafter, we will discuss certain issues, and thereafter we'll move to case studies. And by way of case studies, we will discuss the issues and also various judicial pronouncements and the principles in much detailed aspects. So, Smita, my suggestion is that we can open up Q&A after every case study, but depending on the time, we can also see if it is Q&A is taking longer time, then we can take all the Q&As at the end of the session. I leave on to you.
Absolutely fine. So we take it at the end, once you complete with the technical portion, and then you start with the case studies. Then we can see how to take it forward.
Okay.
Yeah. Thank you. Thank you so much. You can start.
Okay. Good morning, everyone. First of all, I would like to thank IFA to give me this opportunity to share my thoughts on one of the most interesting topic, which is foreign tax credit. And in the interest of time, I will straight away move to the context for today's discussion. Sushilji has already set down the context, and he has already explained that what kind of issues could be there in foreign tax credit. So some of the basics principles. The principles of taxation are largely based either on residence-based or source-based or citizenship-based, as Sushilji just mentioned. There could be various kind of taxation systems. It could be worldwide, like India or USA, or it could be territorial, like Hong Kong, Singapore, etc. Thus, there could be a double taxation. There could be double taxation in 2 modes. One, it could be either economic double taxation, which is where 2 different persons are taxed on the same income in more than one state. And Sushilji gave an example of DDT. So, where DDT is taxed in the hands of the company, or whether DDT is taxed, income is taxed in the hands of the shareholder, which are 2 different persons in more than one state. There could be another kind of double taxation, which is a juridical double taxation, where same person is taxed on same income in more than one state. We often see most of the double taxation in form of juridical double taxation, And most of the treaties which are dealing with foreign tax credit also deals with juridical double taxation. So foreign tax credit is a method for elimination of double taxation. There are various methods which are provided under for FTC. So as per provisions of the Act, wherever India has entered into a DTAA with a particular country, in that case, provisions of section 90 or 90A, as the case may be, will govern the mechanism of foreign tax credit read with respective DTAA. Wherever India has not entered into a DTAA with a particular country, then section 91, which is a unilateral relief, will govern the mechanism of foreign tax credit. Under bilateral relief, which is under DTAA, there are further various kinds of methods provided for elimination of double taxation. One method is exemption method. Another method is credit method. Within exemption method, there could be two kinds of method, which is full exemption, where country of residence exempts from the tax, which is income arising in the country of source fully. Example is India-Brazil treaty. Another method is exemption with progression, which is where country of resident will exempt the income which is arising in country of source, but that exempt income will be considered for the purposes of the rate purposes for other non-exempt income. Example, India-Austria double taxation avoidance agreement. Another method, and which we largely see in Indian treaties, is a credit method. Under credit method, income is not exempted in the country of residence, but country of resident grants credit of the taxes which are paid in the country of source without. So depending on further methods, if it is a full credit method, then there is no restriction. Full tax which is paid in the country of source will be eligible for credit in country of residence. For example, India-Namibia treaty. Another method is ordinary credit method. And this method is largely being followed in Indian treaties, which are based on UN models. Also, the MLI, which has been introduced, also lays down the ordinary credit method and takes away the benefit of the exemption method in couple of the treaties. Now, what is ordinary credit method? Is that tax credit is restricted to lower of tax which is payable in the country of residence and the tax which is paid in country of source. So you cannot get a refund out of extra tax if you have paid in country of source. The credit shall be restricted to the tax liability in country of residence. Now we will see there are various treaties where different kind of languages are used. Some treaties are using the language which is akin to liable to tax, which is as per section 4 of the Indian Income Tax Act, which is the charging section. And there are some treaties which is akin to subject to tax. So once we come to certain case studies, etc., we will discuss this aspect in more detail. Third method under the credit method is underlying tax credit. This is usually in context of the dividend income, wherein the credit granted by country of source is not only for the taxes withheld on the dividend, but also for the corporate tax paid in the underlying profits out of which dividend is paid. We have various treaties like India, USA, Mauritius, Singapore, UK, etc., which gives underlying tax credit. And fourth method under credit method is tax sparing method, which means that even though if tax is not paid in the country of source for certain reasons, like if it is exempt, etc., but country of residence will still provide a credit towards that tax which ought to have been paid in country of source. So the sparing part is being borne by country of residence. Example, India, Oman, DTAA. With this, couple of years back in 2016-17, FTC Rule 128 was introduced. Let us understand the overview of the rules, and in next slide, certain intricacies and whether the rule can override the provisions of the Act and whether rule can override the provisions of the treaty and how. So, Rule 128 provides, there are 10 sub-rules under Rule 128. What kind of taxes it provides, how the credit has to be given under Indian income tax towards the taxes which are discharged in the which are paid in the foreign country. So what kind of taxes are covered? Rule 128 says that if there is a DTAA, then you have to go back to the taxes which are covered by the DTAA. If there is no DTAA, in that case, you have to see explanation 4 to section 91. All kind of tax, surcharge or cess under the IT Act and MAT, alternate minimum tax, etc. is being covered. If it is interest, fee, penalty, etc., then those taxes, those are not considered as taxes and therefore not eligible for FTC. Then it comes to mode of credit. How a credit has to be computed and how it is to be calculated. So it says that you have to see foreign taxes paid by way of deduction or otherwise. Now there are certain intricacies over here. It only says by way of deduction or otherwise. So what happens in case of underlying tax credit where you have not paid that by way of deduction? So what do you mean by term otherwise? So we'll see that in next slide. Source by source and country by country. So subrule 5 of rule 128 lays down that the credit has to be computed qua each source and qua each country. Was this position different before the introduction of rule 128? In my view, answer could be no, because when it comes to treaty country, anyways, we see the respective article of treaty for elimination of double tax avoidance, and we compute the credit in accordance with that particular article of the treaty. And when it comes to the provisions of the Act, okay, section 91 also reads that it has to be country by country, and we already had a ruling in case of Bombay Burma trading from the Bombay High Court in this regard. So to my mind, you know, even after introduction of rule 128, position may not be different. However, the way people used to compute foreign tax credit before introduction of 128 was in the total mechanism, especially in case of section 91, and not the country by country. So rule 128 to my mind clarifies that particular position. Then it says that you have to consider FTC, which is lower of tax payable under IT Act and foreign taxes paid. So it only considers the ordinary credit method under rule 128. It does not consider what happens in case of full tax credit, what happens in case of tax sparing, etc. Further, unlike some other countries, there is no mechanism which is provided under rule 128 for carry forward of excess foreign tax credit. Foreign tax conversion, how it is to be computed, is now given under rule 128. So you have to consider TT buying rate on the last day of the month preceding the month in which taxes were paid or deducted. Then it comes to year of claim, in which year you can get the credit of foreign tax credit. So this is akin to the provisions under domestic law when it comes to TDS, which says that the FTC will be granted in the year when corresponding income is offered to tax. It can be claimed proportionately as and when the income is offered to tax in the respective years. However, if there is a disputed foreign tax credit, so in any foreign jurisdiction, if you have disputed any particular foreign tax, and in that case, what rule says is that you will not get the credit towards a disputed foreign tax unless and until the final settlement is achieved, and final you have further within the 6 months of the final settlement, you have furnished certain required documents. Now, what do you mean by final settlement is nowhere defined. So, for example, if there is any High Court order in any overseas jurisdiction, and if you have filed further appeal before that High Court order, okay, can you say this is a final settlement? Will you say that only after the Supreme Court in the particular country gives any final verdict, then you can say it is a final settlement? So that is not defined. And finally, Rule 128 gives certain compliances which are to be done under Form 67 before the end of the assessment year. The erstwhile Rule 128.9 talked about that Form 67 was required to be filed on or before the due date of filing of return of income. Subsequently, the rule has been amended to say that Form 67 is required to be filed on or before the end of the assessment year. And whether what happens in case of delay in Form 67, whether FTC would be allowed or not, okay, we will just see subsequent slide. Income and certificate from deductor, etc. has to be filed, and proof of payment of taxes in foreign country has to be filed. So with this, friends, as I explained a while ago, what Rule 128 Subrule 5 Subclause 1 reads is that the credit shall be available which is lower of the tax payable under the IT Act and the foreign tax paid on such income. Now, what do you mean by payable? Whether payable can be related to the term chargeable under the IT Act, or whether payable can be read as actual payment of tax under the IT Act, which is akin to subject to tax. So again, word payable is not defined for the purpose of this rule. Secondly, it compares the word payable under the IT Act with foreign tax paid on such income. Okay, so what happens in case of tax sparing? Okay, where you have not actually paid that taxes in foreign jurisdiction, is again not considered under Rule 128.5 Subrule 1. So whether, whether one can see that when there is a mechanism for computation of foreign tax credit, which is prescribed under Section 90 in case of a treaty countries and in Section 91 in case of non-treaty countries, in that case, whether computation mechanism has to be followed as per the DTAA or Section 91, or whether you have to go back and restrict down your computation as per Rule 128 Subrule 5. So whether, if DTA provides for the full tax credit, in that case, whether 128 rule can restrict it to ordinary tax credit by imposing the condition of lower of, as mentioned above. And in case of tax sparing, whether it can actually restrict it to the actual tax paid in the foreign jurisdiction. And what happens in case of underlying tax credit? Because as per Rule 128 Subrule 1, the wordings used are that foreign tax should have been paid by him, paid by assessee. Now, if in case of underlying tax credit, where taxes on this business profits are paid by the company and dividend income is taxed in the hands of the shareholder, can you say that taxes are paid by him? So how do you read this line? And then whether Rule 128 does away with underlying tax credit? So friends, the mute question over here is that, can Rule 128 override the provisions of IT Act or DTAA? An answer to my mind would be no. Rule cannot override, and the supporting that we have for this argument is that Rule 128 have been introduced pursuant to the powers conferred on the CBDT under Section 295 Subclause 2HA, which only says that CBDT has power to define the procedure for granting of relief, and it cannot extend beyond in computation of the amount of the foreign tax credit. We have Supreme Court rulings in case of Sirpur Paper Mills and Taj Mahal Hotels, wherein, Supreme Court has upheld these principles that CBDT cannot, by its power, frame the rules to curtail the scope of the section. And thus, while we will see certain litigation in the coming years, but we will have a very good case to argue that Rule 128 cannot override the provisions of the IT Act or DTAA. Now let us go to certain key issues. So, recently we are seeing many of the rulings wherein courts are dealing with the issue that what happens in case of delay in filing Form 67. So, for example, earlier when Form 67 was required to be filed on or before the due date of return, and now it is required on or before the due date of assessment year. In that case, if there is a delay and say Form 67 is filed during the assessment proceedings, okay, now because of the delay in Form 67, whether you can say that FTC is no longer eligible, is there any condition prescribed under Section 90 or Section 91 that if you do not file Form 67 by XYZ date, in that case, relief shall be taken away? Answer is no. And this answer comes from the reasoning that Rule 128, Sub-Rule 9 does not deny FTC claim in case there is a delay in filing 67 form. It only prescribes a timeline. Further, Form 67 is not mandatory, but it is a directory requirement. And also another argument which we just discussed, that Rule 128 cannot override the provisions of the IT Act, and there is no subsequent amendment under Section 90 or 91 with vis-a-vis this requirement that Form 67 has to be filed within the desired timelines which are mentioned in Rule 128. So we have many rulings from the Bangalore Tribunal, Mumbai Tribunal also, which are being flashed on this particular screen. Few another issues. So what happens in case there is a difference in characterization of income? So for example, say there is an Indian resident which is earning, say, royalty income or FTS income or interest income from a country of source. Now, country of source is taxing that particular income on a gross basis under respective article of DTAA, considering that, Indian company does not have a PE in that particular state. Now, when it comes to the taxation in hands of Indian company in India, say that Indian company is offering that royalty or FTS income to tax as business income. Now, whether the tax authority can allege that because, the income is not taxed under the same head of income, and that is why it is not in accordance with the treaty, and that is why foreign tax credit should be denied. Again, answer here should be no. And we have Supreme Court ruling and tribunal ruling in support of this contention. So Supreme Court ruling in case of KVALM Ramanathan Chettiar held that the word such in the phrase such doubly taxed income. Now this was in context of Section 91, that is Section 49 of 1922 Act. So word such in phrase such doubly taxed income has reference to foreign income, which is again being subjected to tax by its inclusion in the computation of income under the IT Act, and not the same income under identical head of income. Also, we have Kolkata Tribunal ruling in case of Somdat Builders, wherein it has been held that it is not necessary that both state R and state S should tax income under an identical head. However, the prerequisites for the claiming FTC is that income should relate to the same person in both the states. So, even if income is offered to tax under different head of income, okay, FTC should still be eligible. We are also seeing many cases these days in case of ESOPs, where foreign country is taxing ESOPs under some other head of income in the hands of, individuals who are receiving ESOPs in India. He may offer ESOPs under some other head of income, whether salary or whether capital gains, etc. Also, in case of buyback of shares, whether it partakes the character of capital gains or it partakes the character of dividend income is another controversy that we are seeing. So the mute question over here is that in case of different head of income, okay, FTC should still be eligible. Some more issues in context of FTC is that if we take the same example of ESOP, say in the hands of an individual in India, he has received certain ESOP, and say that ESOP is already taxed in foreign jurisdiction. In that case, when it is taxed in India again, whether, say, withholding tax credit for taxes deducted in foreign jurisdiction will be eligible to him while computing his withholding tax liability in India under Section 192. So we have AR ruling in support of this contention that yes, FTC should be eligible in case of Texas instruments, because FTC is coming from Section 90 or Section 91 as the case may be, and it has to be read in conjunction with the provisions of Section 192. Now, another issue is that suppose, tax is withheld in country of source at a higher rate as per the domestic law of that foreign jurisdiction, which is not in accordance with DTAA. So say in DTAA, the rate of tax prescribed is 10%, but as per domestic law, say withholding tax is done at 20%. Now, whether you can say this is in accordance with DTAA, obviously answer is no, and therefore in case of ordinary credit method, okay, this should be restricted to 10%. So there are two things. Okay, when we read the article of elimination of DTAA in model convention or in particular treaty, the first line goes that income should be taxed in accordance with the provisions of the treaty. So first you have to see whether income is taxed in accordance with the respective article of the treaty. Thereafter, when we come to the credit mechanism, then you have to see whether full credit or whether the lower credit as per the domestic law is to be seen. So we have one case study on the method of computation of credit, and we will understand this better over there. But if withholding tax is done at a higher rate as per domestic law, then it cannot be said that it is in accordance, tax is in accordance with the provisions of the DTAA. So the first limb of elimination of DTAA article under treaty is not being met in this particular case. Another example is issue is that whether branch profit tax qualifies for foreign tax credit under India-US DTAA. So, friends, if we go to definition of taxes under India-US DTAA, okay, it talks about federal taxes, okay, and thereafter, when it comes to P, it talks about branch profit tax. So it nowhere eliminates that branch profit tax is not a federal tax, and therefore branch profit tax would be qualified and would be considered as a federal tax and would be eligible for FTC under India-US DTAA. Whether state taxes qualifies for FTC under India-US DTAA. So friends, most of you would be aware about this controversy. We already have Tata Sons ruling in support of this particular controversy, wherein the court has held that even though you have a treaty with US and you have to see provisions of section 90, since state taxes are not covered under the definition of taxes for the purpose of India-US DTAA, and India cannot enter into a separate agreement with US for state taxes, and thus you can go to section 91 and claim credit of FTC under section 91 qua state taxes. So, whether this is a right position, whether you can say that you can go to section 91 only when you don't have any treaty and when you are not eligible for section 90 at all. So we don't have any Supreme Court ruling on this particular issue. But as of now, we have Tata Sons ruling, which is supporting this particular contention that state taxes in case of US treaty, even though you have treaty with US, you can still go to section 91 and claim state taxes under section 91. In case of losses, so suppose there is a loss in a foreign jurisdiction. Say there is an EPC company which is having certain on-site services which is provided from the foreign jurisdiction, and it is doing offshore supply from India. Now say there are losses at foreign jurisdiction and there are withholding taxes which are done at foreign jurisdiction on gross basis. Now here, whether you can claim foreign tax credit on those if there is a losses in the foreign jurisdiction. So answer is that, whether losses qualifies under the definition of income. There has to be doubly taxed income. And answer is yes, losses qualifies for the definition of income. And therefore, even though there are losses at a foreign jurisdiction, if that is again being subjected to tax in India, and if it is a doubly taxed income, then FTC should be eligible on the same. Friends, with this, let us understand various case studies, starting with the first case study on method of computing foreign tax credit. So whether it should be gross method or net method, or whether it should be proportionate method or specific method, as the case may be. Let us understand with help of one example. So say there is an ICO, an Indian company, which is engaged in developing and selling software to worldwide customers, say Singapore, Indonesia, Afghanistan. Now the example taken is with India. India has a treaty with Singapore and Indonesia, but India does not have a treaty with Afghanistan. So as far as Singapore and Indonesia, you have to see respective article of that treaty. And for Afghanistan, you have to see section 91 when it comes to the eligibility on the foreign tax credit. Now say Indian company is subjected to tax at a rate of 22% on its net profits in India. During a year, ICO has sold certain additional licenses of software to its customers in Singapore, Indonesia, and Afghanistan. And say ICO has also provided AMC services to its customers in Indonesia. Say tax is withheld at 10% in Singapore and Indonesia treaty as per DTAA article. And say tax is withheld at 7% in Afghanistan as per its domestic tax law. So the question is, let us see the table and the numbers and let us frame a question for our discussion and deliberation. So say there is a gross receipt from Singapore of 100. Say there are no expenses for this particular gross receipt. Say assessor takes an argument that I have merely sold additional copy of the licenses and I have not incurred any expenses with respect to Singapore sales, and therefore my gross receipts and net receipts as far as Singapore sale is concerned is say 100. Similarly, when it comes to Indonesia, on gross receipts on sale of additional licenses of 120, say there are no expenses and gross receipts and net receipts are same. And say for AMC services, the gross receipts is 80. Expenses incurred for AMC services which are provided to Indonesian customers is say 50 and net profit is say 30. In Afghanistan, say gross receipts is 60 and expenses are not identifiable. So now the question is that how will the foreign tax credit needs to be computed in case of each of these countries, where Singapore and Indonesia has levied withholding tax of 10% on gross basis and Afghanistan has levied 7% on gross basis. So if you see the last column of the table, the total gross receipts at India consolidated level is say 1000, which is including 3 overseas countries and domestic sales in India. Say overall expenses in India are 700 and net profit is 300. So profitability at India console level is 30%. Say India tax rate is 22% and therefore tax at India level is say 66, which is 22% on 300. So effective tax rate in India is 6.6%, which is 66 divided by 1000. Now, the question here is that whether you will apply this 6.6% on the gross amount, which is 100, 120, 80, 60, as the case may be, or whether you will first proportionate the net profit for each of this jurisdiction and then apply the tax rate of 22% directly on that particular proportionate income. So what should be the manner to determine the quantum of income which can be said to have been taxed in both the countries? Gross receipt should be considered as doubly taxed income or net amount. What if no expenses are incurred, or say some expenses may be incurred but not identifiable? Whether proportionate approach has to be applied in all cases or whether you have to see what facts of each particular case. Whether treatment varies if it is a passive income versus if it is a business income. So this first limb is on determination of doubly taxed income. And then we come to second limb on determination of eligibility of FTC, which is whether effective tax rate is to be applied to foreign source gross income, or whether tax rate applicable in India, which is 22% in this case, is to be applied to foreign source net income. So let us understand the model convention article. Also, let us go through the Singapore and Indonesia article in this particular facts, and then go to section 91 and then see what is the language of the respective provisions. So if we read Article 23B of UN Model Convention or OECD Model Convention 2070, the language used is that where a resident of a contracting state derives income or owns capital which may be taxed in other contracting state in accordance with the provisions of this convention. So it says in accordance, it has to be taxed in accordance with the provisions of this convention. Thereafter, when it comes to the credit mechanism of FTC, okay, so this I have taken the example of ordinary credit method, that is Article 23B over here, and then it says that deduction from the tax on the income of that resident is an amount equal to the income tax paid in that country of source, that is other state, and you have to restrict it. The deduction in either case shall not, however, exceed that part of the income tax or capital tax as computed before the deduction is given, which is attributable, as the case may be, to the income or the capital which may be taxed in that other state. So when it comes to the foreign tax credit, limb 2, it talks about word attributable. And when it comes to the doubly taxed income, it says it has to be in accordance with the provisions of the convention or a treaty. Now, let us understand whether language in Singapore Treaty and Indonesia Treaty is same. And answer is yes, it is same. So even Singapore Indonesia Treaty says that income has to be doubly taxed in accordance with the provisions of this agreement. Okay, and deduction cannot exceed that part of the tax which is attributable to the income which may be taxed in the respective country of source. Now, with this background, let us understand first of all whether word income is defined anywhere in the treaty. So income is not defined in Article 23B of OECD Model Convention or UN Model Convention or the respective treaty where we are concerned right now, which is Singapore and Indonesia. So the term which is not defined in the treaty as per Article 3 of the respective treaty, you can come to the domestic law and see if term is defined in the domestic law. Income is defined in the domestic law under section 224, but which is an inclusive definition, and here the meaning and the context is not the same. So, and also income is not defined under Rule 128, which has been prescribed for FTC. Now, let us see if there is anything which we can borrow from provisions of section 91(1). So, section 91(1) uses the language that income has to be doubly taxed income, and thereafter the Indian rate of tax or the rate of tax of the said country, whichever is lower, has to be applied. So it also talks about doubly taxed income. And then there is an explanation 3 to section 91, okay, which is in context of what do you mean by rate of tax of the said country. So the expression rate of tax of the said country means income tax and super tax actually paid in the said country in accordance with corresponding laws in force in the said country after deduction of all relief but before deduction of any relief due in the said country in respect of double taxation divided by the whole amount of the income as assessed in the said country. So what do you mean by whole amount of income as assessed in the said country, which is say India in our example? In this context, we have certain judicial pronouncements wherein the courts have analyzed this terminology and held as under. So in case of Virmati Software and Telecommunication, the Ahmedabad Tribunal has held as under the word used whole amount of income denotes the income which signifies after the expenses. The word gross receipts have not been used therein. Even under the normal parlance, the income denotes only to the net profit. So you have to see net profit and you don't have to see gross receipts. It says gross receipts minus the expenses. Also in case of Best and Crompton Engineering, Madras High Court has held that the word income as is understood for the purpose of section 91 would be the income computed in the normal sense before adjustment of deductions under section 35B. What is contemplated by the term expression income in the said section is not an exact quantum or the measure of the income as computed either in India or abroad for the purpose of taxation in respective countries, but the income as ordinarily understood in a commercial business sense. So within this context, if we go back to our example, okay, and we see that what was held, what was the numbers before us and what was the issue before us is that in context of Singapore, where assessee is able to demonstrate that it has not incurred any expenses qua its receipts from Singapore for additional sale of licenses, whether it is necessary for him to proportionate the Indian expenses, which is 700, okay, to the gross receipts of Singapore, which is 100 divided by 1000, or whether it can directly apply the rate of 22% on 100, which is the gross receipts and the net receipts in Singapore, and therefore compare that in India, the eligible taxes are 22, which is 100 into 22%, and taxes what are paid in Singapore is 10, which is less than 22, and therefore entire foreign tax credit of 10 should be eligible in its hands. So friends, in this context, now we have Ahmedabad Tribunal ruling in case of Allied Core Technologies Private Limited versus DCIT, wherein Ahmedabad Tribunal has considered numbers, practical aspects, and the facts of this case study are based on this Allied Core, and the the principles which are upheld are as under. The expression used is income, which essentially implies income embedded in the gross receipt and not the gross receipts itself. This approach is also reflected in UN Model Convention and OECD Model Convention. Normally, the basis of calculation of income tax is total net income, that is gross income less allowable deduction. Therefore, it is the gross income derived from the source state less any allowable deductions, whether it could be specific, which is identifiable, or whether it is proportional, connected with such income which is to be exempted. It is therefore not really the right approach that you have to consider the gross receipts. So what Ahmedabad Tribunal has said is that in facts of this particular case, wherein say there was additional sale of licenses, additional copies of licenses which were sold, or say there could be certain retention money, in the sense that you have made sales in year 1 and say 85% of consideration was paid to you in year 1, but say 15% of consideration was paid to you in year 2. And as per language of the treaty, say you are offering income on the paid basis, and therefore when it comes to year 2, okay, the receipts in your hands are 15%, which is say 15 rupees of 100, 15% of 100, that is 15, and you really don't have any expenses in year 2 which are incurred towards that particular income. So in that case, what Ahmedabad Tribunal has held that proportional deductions can be justified in some situations, such as when there are business operations which are somewhat evenly or even in a significant manner spread over the residence and source jurisdiction. But if it is a passive kind of income in the facts of this particular case, where in year 2 you have really not incurred any expenses to earn that particular income, in that case, even though it is in the nature of a business receipt, but to the extent allocation of all the expenses incurred by the assessee in India, which is 700 in this example, is not justified. And therefore, you cannot just for the sake of allocating all the expenses, allocate the expenses, and you can thereafter cannot apply the effective tax rate to the net income. So in this case, what Ahmedabad Tribunal has held is that in the facts of this case, you have to see that my gross receipts and net receipts are same qua Singapore and qua Indonesia as far as the sale of software license is concerned, and therefore I have to directly apply the 22% rate in India, which is a specific approach, and I don't have to go into the proportionate approach. However, when it comes to Afghanistan, so we have another ruling in case of Afghanistan, wherein what court has held is that there is no treaty as far as India and Afghanistan is concerned vis-a-vis this taxation, and you have to go to section 91. When you go to section 91, section 91 talks about doubly taxed income, and in that case, in case of Afghanistan, because the assessee was not able to provide any particular explanation towards the expenses, or because the assessee was not able to demonstrate whether it has incurred expenses or it has not incurred any expenses, in that case, the court held that you have to take the proportionate approach. And when you take the proportionate approach, you have to portion 700 rupees of expenses towards the gross receipts from the respective country, that is Afghanistan in this case. And then on the net income from Afghanistan that would have been, on that you have to apply the effective tax rate of India, which is 6.6%. So friends, what principles are coming from various judicial pronouncement is that there may not be any particular thumb rule which may apply in all particular cases, and you have to see facts of the cases in each and every case. Ahmedabad Tribunal has also specifically mentioned in its ruling at the end that we may add that this decision cannot be the authority for the general proposition that only marginal or incremental cost incurred in respect of foreign income should be taken into account and the overheads cannot be allocated thereto. So the specific approach, wherever it is possible, that has to be followed. Where expenses are not incurred and where it can be demonstrated it has not incurred, in that case where net income is same as gross income and where it where it is incurred and specifically identifiable, then the tax rate in India, which may be 22% or 30% as the case may be, has to be directly applied to such foreign sourced income, even though the net income may be same as the gross income. But where expenses have been incurred and not identifiable, in that case proportionate approach has to be followed, and in that case after determining the proportionate net income in India, the effective tax rate in India has to be applied. With this I am going to next case study, which is on the principle whether foreign tax is a deductible expenditure or not. So say there is an Indian company which enters into a composite EPC contract with overseas customers comprising of offshore supply and services and onshore supply and services. Now, offshore supply and services is carried out by ICO's branch in the respective overseas jurisdiction. This should be on-site. There is a typo error over here. So, on-site supply and on-site services is carried out by ICO's branch in the respective jurisdiction. So, say ICO has a branch in say Philippines, and Philippines buying it caters to the customers in Philippines, and it provides onshore services and provides onshore supplies as may be required by the Philippine customers in Philippines. Now, say basis the domestic tax law of Philippines, taxes are withheld on the composite value of the contract, that is onshore as well as offshore, despite the breakup of pricing explicitly mentioned in the contract. Also, withholding tax rate applied as per certain domestic tax laws, like various South African countries have this concept, where withholding tax rate is the final tax, and you cannot have the refund from that particular tax liability. So, in context of these facts, first of all, whether you can say that offshore supply and offshore services which have been taken place from India and not from the overseas jurisdiction, whether this is a doubly taxed income. So whether entire withholding tax which has been done in the host country at a rate higher than the rate prescribed in the DTAA, first of all, whether it will be eligible for FTC as per provisions of DTAA. So answer would be no. So in this case, what EPC company would be doing, it would be as far as offshore supply and offshore services is concerned, it is an Indian source income and it is not a foreign source income, and ideally it is not attributable to its branch in that overseas jurisdiction and therefore not taxable in the overseas jurisdiction in accordance with say Article 5 read with Article 7 of that particular treaty. So it is not a doubly taxed income. Only onshore supply and onshore services which has been taken care by ICO's branch in that overseas jurisdiction, which is again consolidated in India and offered to tax on a worldwide income basis in India, that onshore supply and onshore services will become a doubly taxed income. So if withholding tax is done on a composite value of the contract, then it may not be in accordance with treaty and therefore FTC may not be eligible on the entire amount. Now, having said if FTC is not eligible on the entire amount, the next question which arises is that whether for excess foreign taxes which are ineligible for FTC, for that whether you can claim deduction under section 37(1) read with provisions of section 48(2) of the IT Act. So friends, you may all be aware about the Bombay High Court ruling in case of Reliance Infrastructure. The observations which I want to make on that particular ruling, and that is why I have selected this case study, is to discuss and deliberate whether, whether one can say that Bombay High Court ruling is a per incurium ruling and it has not discussed certain other rulings which were there before deciding the issue in favor or against the SSC. So friends, let's understand what do you mean by uh, uh, first tax under 48(2). So section 37(1) is a general section which provides a deduction. There is section 48(2) which says that certain amount shall not be deductible, and 48(2) talks about disallowance of tax. So the way it reads is that it starts with a non-obstantive provision, notwithstanding anything to the contrary in sections 30 to 38, the following amount shall not be deducted in computing the income chargeable under the head profits and gains on the business and profession. And clause number 8, subclause number 2 reads like this: any sum paid on account of any rate or tax levied on the profits or gains of any business or profession, or assessed at a proportion of or otherwise on the basis of any such profits or gains. So the language which is contained in section 48(2) is that any sum paid on account of any rate or tax levied. Now, whether for the purpose of this particular section, what is the meaning of the word tax? Will you go to section 2, subsection 43 of Indian Income Tax Act, which defines tax like this: tax in relation to assessment year commencing on 1st day of April 1965 and subsequent assessment year means income tax chargeable under the provisions of this act. So if we go to section 243, it says tax means income tax chargeable under the Domestic IT Act. So the mute question is that whether foreign taxes are covered for the purpose of section 48(2) or not. So how do you read word any rate or tax levied? Whether word any goes with word rate and also with word tax both, or whether word any, if you do not read along with in conjunction with tax, then whether you can say then it is meaningless and therefore it does not give the proper proposition of the terminology in which it has been defined. So friends, in case of Lubrizol, we have Bombay High Court ruling in case of Lubrizol, wherein Bombay High Court, while analyzing the word tax for the purpose of 48(2), it has held that tax is used in conjunction with the words any rate of tax, any rate or tax. Now the word any goes both with rate and with tax. And therefore, if word tax is to be given meaning assigned to it under 243, then the word any will become meaningless. So in this case, Lubrizol, Bombay High Court has held that because you have to read word any along with word tax, and therefore it is not confined only to Indian Income Tax Act, and therefore foreign taxes are also covered for the purposes of section 48(2). And if foreign taxes are covered under 48(2), then you cannot claim deduction under section 37(1). And this was being upheld by many other courts following the Lubrizol, which was in case of KC International, Kerala Lines, Smith Lines, which is a Supreme Court ruling, Smith Line and French India, that also upheld the principles in case of Lubrizol and held that, foreign taxes are covered for the purposes of 48(2). So all these rulings were before the amendment under section 48(2) by way of Finance Bill 2006, wherein explanation was inserted to the provisions of section 48(2). So the wordings of the explanation 1 read like this: for the removal of the doubt, it is hereby declared that for the purpose of this subclause, any sum paid on account of any rate or tax levied includes and shall be deemed always to have included any sum eligible for relief of tax under section 90 or as the case may be, deduction from the Indian income tax payable under section 91. So friends, if 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 we have to take a meaning that tax is to be confined only to Indian income tax as per 243, if that was the proposition, what was the need of introduction of explanation 1? So whether this explanation 1, okay, which talks about the relief of the foreign taxes under section 90 or 91 as the case may be, is this expanding the scope of 40A2 or is this explaining the scope of section 40A2? This is the controversy which we need to understand. And if we see the memorandum at the time of introduction of this explanation under Finance Bill 2006, it reads as, there was a double benefit which was claimed by some taxpayers. So taxpayers used to claim relief under 1991 for foreign taxes, and at the same time they used to claim deduction under section 37. And therefore, in order to do away with the double deduction, 40A2 explanation has been brought in. But if 40A2 was always clear that it only restricts to 243 and it only refines to Indian Income Tax Act, in that case, how can you say that, if you read this explanation, which says that for the purposes of this subclause, any sum paid on account of any rate or tax includes and shall always have been deemed to have been included any sum eligible for the relief. So are you saying that, foreign tax was always included? Okay, and therefore you are saying that if you have claimed foreign tax under section 1991, then you do not claim it again under section 37. To my mind, this is not a correct, this should not be the correct proposition. And we have the, understanding from all this Lubrizol and all this Smithland case laws. However, there are some case laws which has taken a contrary view, which is in favor of the SSC. In case of Southeast Asia, followed by Mastec and followed by Allied Core, in another ruling of Allied Core of Ahmedabad Tribunal, wherein the proposition which has been upheld is that taxes which are levied by different foreign countries is not a tax levied on the profits, but it is a necessary condition precedent to earning of the profits, and thus doesn't get covered under the ambit of the provisions of section 48(2) of the IT Act, and accordingly allowable as deduction under section 37 of the IT Act. So it says that foreign taxes are condition precedent for earning of income in that particular jurisdiction, and it is not an appropriation of tax, and therefore it should be allowed under section 37. So friends, this were another set of rulings wherein foreign taxes were allowed as a deductible expenditure. And thereafter, now we have Reliance Infrastructure ruling by Bombay High Court, wherein the Bombay High Court has analyzed these terms and has held that it to be covered under 48(2), tax has to be payable under the act which is under section 2 subsection 43. Explanation to 48(2) clarifies that tax for the purpose of 48(2) shall include tax eligible for relief under section 90 or 91. Since in this case, relief is not available under 90 or 91, disallowance provision is not applicable. And the earlier ruling of S. Indergill in case of Bombay High Court, it has distinguished that it cannot be followed in this case because that ruling was rendered in context of 1922 Act, when there was no corresponding section like section 2 subsection 43 which is there under 1961 Act. So Bombay High Court in case of Reliance Infrastructure has held that for the purpose of section 48(2), you have to see the meaning of the tax as per 243, which is Indian income tax and not foreign tax, and therefore foreign taxes are not covered under 48(2) and therefore eligible for deduction under section 37. However, Bombay High Court has not considered the rulings which are pronounced in case of Lubrizol and in case of Smithland by Honorable Supreme Court. Thereafter, after Bombay High Court ruling, there is another ruling of Allied Court in Ahmedabad Tribunal, wherein Ahmedabad Tribunal has distinguished the Bombay High Court and it has placed reliance on Lubrizol and Smithline in French Supreme Court ruling and has taken a position that explanation to section 48(2) vis-a-vis main provisions of 48.2 do not extend to the scope of 48.2. It only explains the scope of 48.2. If something is covered by the explanation, it cannot be said that it is not covered by the main provisions. And therefore, it has gone back to those rulings and has taken a principle that word any goes with both rate and tax, and therefore foreign taxes are also covered under 48.2, and therefore deduction ought not to be eligible under section 37.1. So friends, with this, the proposition, what I wanted to highlight is that whether it can be said that Bombay High Court ruling, since it has not considered various rulings of another Bombay High Court, which was Luprizol, and Supreme Court ruling in case of Smith Line, whether you can say Bombay High Court ruling is a per incurium and therefore it is not a binding precedent. So friends, I wonder that litigation would be seen on this aspect on a going forward basis. While today there are many tribunal rulings which has placed reliance on Reliance Infrastructure Bombay High Court ruling and given a positive ruling in favor of the SSC. However, in my mind and in my view, this could be considered as a per incurium ruling and may not be binding. And one can go with allied court ruling, which is although against the SSC and in favor of the department. Friends, with this, let us come.
Monika, can I, there is one question for case study 2. Can I take it up?
Yes.
So, in case study 2, you mentioned that offshore supply is not doubly taxed. Can you go over this fact again?
So, the facts of my case were that, offshore supply completely happens from India. Okay. And it is not attributable to the branch which is situated in a foreign country, say Philippines in this example. And therefore, offshore supply, you cannot say it is doubly taxed. So, now there are various controversies which can arise here also, wherein what do you mean by source of income? So we have various rulings in context of section 9, subsection 17, which is the exception to 917, wherein courts have discussed that what do you mean by source of income? If you have customer outside India, can you say that is your source? And therefore, or whether you can say if entire activities are taking place of India, there is no source outside India, even though there is just a customer who is placed outside India. And we have certain other rulings in case of Ahmed Bhai, Umar Bhai, wherein courts have also laid out the principles that in case of offshore, you have to see the complete activities that, for example, say manufacturing activities, if it is taking place in India, and sales and marketing activities, if it is taking place in, say, overseas jurisdiction, then how in the entire gamut of services you can apportion the respective activities in country of residence and country of source, and that is how you have to see. But for the facts of this case study, I had assumed that entire offshore supply, offshore services takes place from India, and relying on those rulings wherein courts have held that merely because customer is outside India, you cannot say that source is outside India. And that is why I say that offshore may not be held to be a doubly taxed income. So it is only income which is taxed in India, and it should not be taxable in the source jurisdiction because it is not attributable to the branch activities undertaken by the branch in the source jurisdiction.
So there is one more question lined up. Can I take that also?
Yeah.
So due to the ineligibility of the foreign tax relief under section 90 and 91 of the Act, an assessee is not being able to recover this amount from the foreign clients and is resulting into loss incurred during the course of carrying on its profession. Such loss is a loss incidental to the business profession. Can a view be taken that loss incurred due to non-realization of the relief or credit for taxes withheld by foreign clients is in nature of loss in the normal course of business and hence allowable under section 28 of that?
So Bhumika, your question is that suppose, if we go with the argument that say, Bombay High Court ruling may be considered as per incurium and say foreign taxes are ineligible for deduction under section 37(1), in that case, whether you can take resort or shelter to provisions of section 28, and whether you can say that, it is a loss in the course of the business. So, again, then you go back to those rulings in case of Mastec, wherein it is held that, this expenditure are not cannot be foreign taxes which are paid in foreign jurisdiction are not the appropriation of income, but it is an expenditure incurred which is incidental and a precondition to undertake business in that particular jurisdiction, and therefore whether you can take a shelter of those ruling and claim loss under section 28, which is a argument that you may explore.
Thanks. You can continue. Thanks.
Okay. Okay. So friends, let us go to next case study. Another interesting case study. So this is in context of, interplay between provisions of section 80M, section 115 BBD and foreign tax credit. So first of all, let me clarify what is 80M, 115 BBD, while we have reproduced the language and we'll go through word by word. But before that, let us understand the facts of the case and what is and why I have selected this particular case study. So there is an XYZ company, which is a foreign company, which is a wholly owned subsidiary of an Indian company, ICO2. And say ICO2 is a wholly owned subsidiary of another Indian company, ICO1. Now, say XYZ foreign company declares and pays dividend to ICO2. And in the same year, say ICO2 declares and pays dividend to ICO1 out of that foreign dividend which it has received from XYZ Co. So the question here is that, now as per the law which stands today, dividend is taxable in the hands of shareholder and there is no DDT in the hands of the company. So I have taken two scenarios. One is if this transaction has taken place in first week of March 2020, and if this transaction has taken place in first week of March 2023. The reason for taking these two different dates is that the provisions of section 115 BBD, which is a special rate of tax of 15% on foreign dividend income, is no longer applicable from assessment year 23-24, that is financial year 22-23. And therefore, when we are looking into scenario 2, wherein the entire transaction has taken place in March 2023, in that case, you don't have to see provisions of 115 BBD. You only have to see ATM versus FTC. If we see the transactions, if it has taken place in March 2020, then 115 BBD was applicable. And when Finance Bill 2020, which introduced the taxation of dividends in the hands of the shareholder, has reinstored the provisions of section 80M in order to cascade the effect of the taxation of dividend in case of the intercompany dividends. So friends, with this background, let us now understand that how to read provisions of section 80M, 115 BBD and FTC in the given case. So question before us in this case study is whether deduction under 80M is qua gross total income or whether it is qua foreign dividend income. How does subsection 2 of 115 BBD is to be read? Does it prohibit the deduction under 80M from foreign dividend income? And whether deduction under 80M is eligible against foreign dividend income taxed at special rates under 115 BBD? Whether the special rate under 115 BBD subsection 1 is to be applied on the gross dividend or on the dividend income net of the deduction under section 80M, and whether FTC would be allowed in India on foreign tax paid on foreign dividend if the foreign dividend is taxed at a special rate. So friends, the section, the placement of the section, the wording of the section, okay, under which chapter it is coming from, etc., is important for us to understand the controversies when we understand applicability of section 80M versus 115 BBD and correspondingly foreign tax credit as per provisions of section 1991 as the case may be. So friends, before I go to these examples on the case study, okay, we can go through the provisions of the section, okay, and then go back to the table to understand that what is the question before us okay, which I explained, which I read in the above paragraphs. So say, let me read the provisions of section 80M and let me read the provisions of section 115 BBD and go back to the table and go back to the questions. So 80M reads like this, where the gross total income of a domestic company in any previous year includes any income by way of dividend from any other domestic company or a foreign company or a business trust, there shall, in accordance with and subject to the provisions of this section, be allowed in computing the total income of such domestic company a deduction of an amount equal to amount by way of dividend received from such domestic company, which does not exceed the amount of dividend distributed on or before the due date. So it says that, where a domestic company has received any dividend income from any other domestic company or a foreign company. In that case, if it has in turn declared a dividend, okay, in the same year on or before the due date, in that case, he is eligible for deduction under section 80M. Then we come to provisions of section 115 BBD, which talked about special rate of tax in case of foreign dividend income. So subsection 1 reads like this, where total income of an assessee being an Indian company includes any income by way of dividends declared, distributed or paid, the income tax payable shall be aggregate of amount of income tax calculated on income by way of dividend at 15% and the amount of income with which assessee would have been chargeable had its total income being reduced by that particular dividend income. So that is how it has to be seen. And then there is subclause 2 under 115 BBD, which starts with the non-obstante provision. It reads like this, notwithstanding anything contained in this act, no deduction in respect of any expenditure or allowance shall be allowed to the assessee under any provision of this act in computing its income by way of dividends, which are referred to in subsection 1. So friends, the controversy now, if we can understand with the example of the table, okay, is that, say under scenario 1, profits and gains of business and profession in hands of an assessee is say 500. Under the head in IFOS, that is income from other sources, foreign dividend income is say 300. So gross total income is say 800. Now, if deduction under 80M is claimed, qua that foreign dividend income, assuming that, foreign dividend income is in turn declared and distributed by that Indian company to another Indian company in the given timelines, then 80M is say 300. So the total income, which is gross total income of 800 minus 80M of 300 is say 500. Now, question is that out of this total income of 500, what is the tax rate which you will apply and on what portion? So can you say that income taxable at special rate under 115 BBD is 0 in this case because entire foreign dividend income has been claimed as a deduction under section 80M and therefore there is nothing left out as a dividend income for the purpose of section 115 BBD and therefore no question of applying 15% rate of 115 BBD. So the entire total income, which is 500, is towards PGBP and therefore you need to apply the normal tax rate, say 25%, okay, and 25% of 500 is 125. So the total tax liability comes to 125. And also because, this income is not subjected to tax again in India, as you have got entire credit under 80M, and therefore there is no question of doubly taxed income, and therefore no foreign tax credit, and therefore 125 is the total tax liability. Whether that is a correct proposition or whether scenario 2 is the correct proposition. So scenario 2 reads like this, where it say profits and gains is 500, dividend income, foreign dividend income is 300, so gross total income is 800. Now, if you are claiming deduction under 80M of 300 and say total income is 500, can you take a position that deduction under section 80M is qua gross total income and deduction under 80M is not qua a specific category of income which is a foreign dividend income. And once the dividend income is part of IFOS and once it is part of gross total income, it loses its identity and therefore you cannot have one-to-one matching or comparison that deduction under 80M is qua that particular source of income which is a foreign dividend income, but instead 80M is qua gross total income and therefore even though you have claimed 80M, the balance income which is a total income of 500, first you have to see that out of 500, okay, I had a special income of 300 and therefore towards that special income of 300, I will still apply 15% rate which is 45 and on the balance income of 200, I will apply a normal rate which is 25% which comes to for 50 rupees and therefore the sum total of taxation in this case comes to only 95 as against 125 in scenario 1. And if, for example, I go with the same theory that, 80M is qua gross total income and not qua particular source of income. And if I also apply the provisions of the principles upheld by Honorable Bangalore High Court in case of Wipro and also followed by various other rulings wherein it has been held that it is not necessary that you have to actually pay the tax in India. It is fine so far as the tax was chargeable to tax in India. Okay. And if you have not paid because of, say, exemption under section 10A or 10AA, as the case may be, in that case, you are still eligible for foreign tax credit. And therefore, here, say, this foreign dividend has also been subjected to tax in that foreign country at 15%. And therefore, 45 is the tax which you have paid in a foreign country. And thus, you have to consider 45 as a foreign tax credit against 95. And thus, your final tax liability in India comes only to 50 rupees as against 125 rupees in scenario 1. Friends, I hope you all are with me as far as the controversy, what I want to discuss. And if yes, then I can proceed ahead with reading of the technical provisions and my views on the same. If there is any gap in understanding of the facts, Smita, if there is any question from anybody, we can take it right now, or else I can proceed.
There's no question. Please proceed.
Okay, fine. So, friends, in this context, it is necessary for us to understand what is the wordings of 80M, what is wording of 115 BBD, in what context it has been introduced, how it has been placed under which chapter, etc. So, while we read the provisions in nutshell ago, now let us read, with proper focus with the underlined term and highlighted terms which I have made on this slide. So, section 80M, okay, it starts with the terminology where the gross total income of a domestic company includes so and so, okay, and you have to see to 80M for computing total income. So, nowhere it says that 80M is for, computing dividend income. So the way it reads now, if we can read it again, is that where gross total income of a domestic company in any previous year includes any income by way of dividend, it only said in gross total income includes income by way of dividend from any other domestic company, foreign or a foreign company or a business trust in accordance with and subject to the provisions of this act be allowed in computing the total income. So the scheme of taxation in India is there is a gross total income wherein various heads of income are being taken total of, and then you come to gross total income, and gross total income is also defined under provisions of section 8IB5 as under, which says that gross total income means the total income computed in accordance with the provisions of this act before making any deduction under this chapter. So it says you have to see total income before any deduction under this chapter. 80B is part of chapter 6A and so is provision of section 80M. So before deduction under chapter 6A, okay, you have to see the gross total income in order to compute the total income. So Friends, with this, if we now go to the provisions of 115 BBD and the language, the 115 BBD starts with where the total income of an SSC. So, where the total income of the SSC means there would be gross total income minus chapter 6A deduction. Then you come to total income. Correct? So it reads where the total income of an SSC being an individual includes any income by way of dividends declared, distributed, paid by a specified foreign company, the income tax payable shall be aggregate of the amount of income tax calculated on income by way of such dividend at 15% and the amount of income tax with which the assessee would have been chargeable had its total income. Okay, so this is not relevant for us. And then it says notwithstanding. So friend, this is the controversy. And further, when we go to subsection 2, okay, so subsection 1 of 115 BBD talks of special rate of tax of 15% in case where total income includes any foreign dividend income. And how to compute that total income or what is the meaning of that total income or dividend for the purpose of this total income is given under subsection 2, which starts with non-obstante clause. It says notwithstanding anything contained in this act, no deduction in respect of any expenditure or allowance shall be allowed to the SSC under provisions of this act in computing its income by way of dividends referred to in subsection 1. So now if in light of this, we go back to each individual question. Okay, so if we read first question part 2, how does subsection 2 of 115 BBD is to be read? Does it prohibit a deduction under 80M? So it says that no deduction shall be allowed, okay, in respect of any expenditure or allowance. Now, first of all, okay, what is the context of subsection 2? Subsection 2 of 115 BBD says that for computing dividend, which is a foreign dividend, okay, you don't have to consider expenditure or allowances, which means that when you are computing foreign dividend income under the head IFOS, you don't have to consider certain expenditure allowances, which may be, for example, say provided under section 57. Section 57 provides for certain expenses which you may have incurred in context of dividend. So this subsection says that you don't have to consider those kind of expenditure. Does it ever say that you don't have to consider deduction under section 80M? To my mind, answer would be no, because first of all, whether, 80M is an expenditure? No, it is not an expenditure. It is a deduction under chapter 6A. Okay, is it an allowance? One can say it is some kind of a deduction or some kind of a relief, and therefore, somebody can say it is an allowance, but it is not in context of determining the dividend income. And therefore, here you have to see that only those kind of deductions under section 57, okay, is not to be considered when you compute foreign dividend income for computation of foreign dividend income under the head IFOS. Now, when you compute, so IFOS is, then gets consolidated into gross total income and ATM and then total income. So this is how in my mind you have to read. Thereafter, the second question is that, whether ATM is qua gross total income or qua foreign dividend income. So as the language reads of ATM on first line, it says where the gross total income, and therefore, okay, ATM looks like it is qua gross total income. And when dividend income forms part of gross total income, it loses its identity. However, I would like to highlight the memorandum, okay, which was being brought as a part of Finance Bill 2020 at the time of reintroduction of section ATM, which read like this: insert new section ATM as it existed before its removal by Finance Act 2003 to remove the cascading effect with a change that set-off will be allowed only for dividend distributed by the company 1 month prior to the due date of filing of return in place of due date of filing of return earlier, etc. So it uses the word cascading effect. Now, when can you use the word cascading effect? Only if it is in context of the dividend income. Okay, so that is an objective that, it should not be taxed twice in the hands of the company, and therefore to remove the cascading effect, ATM was introduced. If this is the philosophy and this is the rationale for reintroduction of ATM, in that case, okay, even though the language reads that where it starts with gross total income, okay, going by the memorandum language, one can still contend that, it is qua that particular foreign dividend income. And that is how you have to go as per the intention. And therefore, you can take another view, okay, that yes, you have to see one to one. That is scenario one in my case, that you have to see one to one, that if you have taken ATM deduction, then there is no base of foreign dividend which is left out in that particular total income. And therefore, there is no question of applying any special rate of tax under section 115 BBD. So, that is what is coming from this. And we have, some analogy which we can draw from one of the CBDT circular 721 of 1995, which was in context of section 112. So, friends, there are various provisions for special rate of tax like 112. There is also one section 115A, which talks about, where you offer special income to tax at gross rate of tax of say 10% or now 20%. In that case, subsection 4 of 115A explicitly mentions that Chapter 6A deduction shall not be eligible in order to compute the income under the special rates, and you have to apply the gross rate, okay, on that gross income. So there is an explicit provision, okay, but there is no such explicit provision under 115 BBD, and that is why this controversy is being arising. So in this context, another example, if we can take, is this 112, okay, which is in context of capital gains taxation, long-term capital gains taxation, wherein in the similar language of 115 BBD, what CBDT circular reads is like this: the total income is to be computed in the manner prescribed in the IT Act. Set off of the loss as per the provisions of section 70 to 80 is a stage which is a part of this procedure. When this procedure is adopted and computing gross total income or total income, only the amount of income after set off which remains under the head as part of the gross total income or total income, only that amount of long-term capital gains which is included in such total income would be subject to tax at a prescribed flat rate. So this circular for 112 explicitly says that for computation of long-term capital gains, you have to set off your losses under section 70, etc. Then you have to see what is the final amount of capital gains, which is forming part of the gross total income or total income. And then you have to apply that special rate only vis-a-vis that particular income and not the total amount of long-term capital gains. So if we draw analogy from this particular circular, okay, this supports scenario number one, that is, even though the language of ATM is, although it is gross total income, but you have to see it qua the foreign dividend income, and therefore you don't have to again consider it for the special rate. And you now we come to FTC also, and we have some supportings on FTC as far as section 91 is concerned, so which is unilateral relief. So in context of section 91, Andhra Pradesh High Court in case of CS Murthy and Rajasthan High Court in case of RN Ranji has held that wherever deduction was claimed under section 80 RRA with respect to foreign sourced income, in that case, only the balance income could be considered as the doubly taxed income for the purpose of section 91. And only that balance income qualifies for the foreign tax credit under section 91. So if we go with this supporting, then, scenario one looks like the correct proposition. However, if we go with the proposition that no, you have to strictly read ATM qua gross total income, and if dividend income loses the identity, in that case, you can still apply the entire deduction of ATM. I mean, even though ATM is applied, it is qua gross total income, not qua any particular foreign source income. And therefore, whatever total income is left, there you have to see first how much was your foreign dividend income, appropriate that much towards foreign dividend income, apply special rate of tax, and only on balance amount you apply the normal rate of tax. And with this analogy, you also give the foreign tax credit okay, by relying on the rulings in case of Wipro and in case of Tata Sons. So, uh, in this context, so in context of FTC, I also want to highlight that when you go as per the language of the treaty, as per the respective DTAA, there are some treaties wherein language used is akin to attributable to income, which may be taxed in that other country, that is chargeable to income, even though there are specific deductions like ATRRA or ATM, which is available, or 10AA, which is available. Okay, if income is chargeable to tax in India, in that okay, then you can still claim the FTC as per the respective treaty wherein word attributable is used. But if treaty uses the word which is akin to subjected to tax in both the countries, okay, so for example, certain treaties like UK, Canada, Australia, etc., which uses this terminology, there the strict interpretation, you have to see the word subjected to tax, which is narrower term, and therefore the actual tax outflow in India will only qualify for FTC and not the income which was otherwise chargeable to tax in India. So depending on the language of the treaty, you have to see whether FTC would be eligible or not. If treaty language is attributable to income, it is chargeable to income, in that case FTC would be available even if ATM deduction is claimed. But if treaty language is subjected to tax and if ATM deduction is claimed, in that case, FTC shall not be eligible. Having said that, with respect to US treaty itself, we have a contrary two rulings, okay, which takes different proposition. So US treaty, the Wipro in case of Karnataka High Court in case of Wipro, which is also followed by Tata Consultancy Services in case of Mumbai Tribunal, has held like this. The conditions mandated in the treaty is that if any income derived and tax paid in US on such income, then tax relief or credit shall be granted in India on such tax in US. The said provision does not speak of any income tax being paid by resident Indian under the Income Tax Act as a condition precedent for claiming the said benefit, where the Indian resident pays no tax on such income which is derived. And if we see the contrary ruling in case of Manpreet Singh by Delhi Tribunal, there it has been held again in context of US treaty like this. The assessee could not claim credit of taxes paid in USA against his other income, which was chargeable in India and which was not doubly taxed. The credit could be allowed only against doubly taxed income. That is clear from the wordings of Article 25. India shall allow as a deduction from the tax on the income of that resident. Thus, the prerequisite is that there should be tax on income of the resident. So if you are claiming deductions like say ATM, there is no tax on income of the resident, and therefore on the first principle itself there is no double taxation, and therefore relief should not be granted. This is the proposition which Manpreet Singh has adopted, Delhi Tribunal has adopted in case of Manpreet Singh. Friends, we have how many?
We have, Monica, we have 20, I mean, we are already on 12:40, so we have another 30 minutes. We have
Okay.
2-3 questions on case study 3. Can we take it up?
Okay, fine. We can take it up. But I would like to complete entire case study 4 because it is a very, very interesting case study.
Done. So let us take, I'll just put up all the questions together and then you can take it up one on one. So
Okay.
one is that for the purpose of calculation of ETR, whether book profit is to be considered and profit after adjustment of allowance and disallowance under IT Act should be considered. That is one question. Then in practical situations while filing the return of income, the utility doesn't allow us to claim deduction under ATM on 115 PBT income.
Correct. So, as far as the IT form is concerned, the question which has been put up is correct. In that case, we don't have any resort to claim under form ITR, but in case of assessment proceedings, the claim can be put up. Okay, that is one proposition. When the question is that for the purpose of calculation of ETR, whether the book profit is to be considered and profit after adjustment of allowance and disallowance under IT Act should be considered. So if we go to Rule 128, Rule 128 considers MAT as an eligible tax, okay, and it also gives the credit of the MAT credit in the subsequent years. So when you compute ETR, okay, what it says is that if you are paying tax today, okay, under MAT, you have to consider that, and in the year when MAT credit is being claimed, okay, in that year you will get a deduction, and therefore ETR needs to be adjusted accordingly as per the provisions of the MAT. There is another question.
Thank you.
In practice situation, while filing return of income, this we have already considered.
We have done all the questions. Yeah, there's one more question. So PE of a company in Kingdom of Saudi Arabia has deducted withholding tax from the payment made to Indian company during the year. India-Saudi Arabia treaty doesn't have FTS clause. In that scenario, will the FTC be allowed in Indian company?
So see, first of all, if there is no FTS clause, okay, in that case, whether you fall back to other income article or whether you can take a proposition that if there is no FTS clause, okay, in that case, that income is not taxable if you do not have a PE. So the question really here is that, as I said, the model convention, DTAA article on elimination of double taxation is divided into two parts. First part reads that income has to be doubly taxed in accordance with the provisions of the treaty, and then it talks about the credit mechanism. So when it talks about the first mechanism, which is in accordance with the provisions of the treaty, there you have to see whether, if FTS clause is absent, okay, and if withholding is done, first of all, whether you can say if this income is doubly taxed in accordance with the provisions of the treaty. So there are many rulings which has held that if FTS clause is not present and you do not have a PE in that country, in that case, it will be considered as a business income, not taxable. There are some contrary rulings which says that when you go to the residuary article, which is other income article, again, when you go to other income article, okay, there is a clause that if you have a PE in that particular country, then, and if other income is attributable to that PE, then you fall back to business article. And if there is no PE, in that case, no business income taxable. So only the thing I wanted to highlight is that, so you have to consider the proposition of the rulings, and if it is not in accordance, if income is not taxed in accordance with the treaty, you can take a position that in absence of FTS clause, this income is not taxable, and therefore, if it is not taxable, then it is not in accordance with the treaty, then you are not eligible for FTC. Because you can't say that because I want to claim FTC, I would say this is in accordance with the treaty, I want to take this income under other income clause and make it taxable.
Right. Thank you. Thank you. You can continue with the fourth case study.
Sure. So this is a very interesting case study, which is in case of FTC in triangular cases where the PE is in India. Let us understand facts of this case and the tax treatment in each of the three countries. So say there is a Spain company, which is a company incorporated and resident of Spain, and it has a PE in India, which is called, say, Indian PE or Indian branch. And say there is a Sweden company, which is paying interest income to this Indian PE or branch, and this interest income is attributable to Indian PE or branch. Now, say, as per provisions of Article 11.2 of India-Sweden Treaty, interest income is taxable in source state at 10%. And say, as per Article 11.2 of Spain-Sweden Treaty, interest income is taxable in source state at 15%. And say, as per domestic law of Sweden, withholding tax rate is 20%. I just have to apply my charger. Can you give me 2 minutes?
Please go ahead.
Yeah. Am I audible?
Yes, you are.
Okay, I will just stop my video for the time being. Okay. Screen is visible, Smita?
Yeah, screen is visible.
Okay, fine. So, in context of this, now let us understand the tax treatment in the respective countries. So, at Sweden level, what will happen? If Sweden wants to withhold tax on this interest as per provisions of DTAA, then which DTAA needs to be applied by Sweden? Would it be India-Sweden treaty or would it be Spain-Sweden treaty? That is the question. We will go to India level questions and Spain level questions later. First, let us deal with each country. So let us go to Sweden. So first of all, if Sweden has to see that for this interest income, which article of which treaty is to be applied, okay, it has to see uh, which treaty is applicable. Now, as we understand the principles of treaty, as per Article 1 of Model Convention, DTAA applies to persons who are resident of one or both of the contracting state. In this case, Indian branch of a Spain company is neither resident of India nor it is resident of Sweden. Sweden is the source country in this example because it is paying interest income. So provisions of India-Sweden DTAA are not applicable. Since India branch of Spain Co is considered to be a resident of Spain Co, it will be a Spain-Sweden treaty which will be applicable. Now, as per Article 11.2 of Spain-Sweden treaty, interest income is taxable in the source state, which is Sweden in this case, at 15%. And therefore, if Sweden has to apply the treaty provisions, it has to apply Spain-Sweden treaty provisions and do withholding at 15%. Now, what will happen at India level? Whether Indian branch can claim foreign tax credit of taxes which are withheld at Sweden at 15%? If yes, under which section, whether under section 90 or whether under section 91? And under which DTAA? Under India-Sweden or India-Spain DTAA? And how much? 10% or 15%? So, friends, there is an Indian PE. It has a business income in India. This interest income is attributable to that PE. Interest income is derived from Sweden, which is a source state. Question is, can branch get the foreign tax credit? For getting foreign tax credit, you should be eligible for either, if you are a resident, you can go to section 91, which is not in this case. Because branch is not resident of India, it cannot go to section 91 as section 91 applies only in hands of the residents of India. So now the question is, if foreign tax credit is to be claimed by this Indian branch, under which treaty will it claim? Will it claim under India-Sweden? Does it have access to India-Sweden treaty? Or whether it has to go to India-Spain treaty or which treaty? So as we discussed in the earlier slide, because Indian branch is neither resident of India nor it is resident of Sweden, and therefore it is not eligible for India-Sweden treaty, and therefore it will not be eligible for Article 24 of India-Sweden treaty. Now, if it is not eligible for Article 24 of India-Sweden treaty, okay, can it claim credit of taxes which are withheld in Sweden? Can it claim credit in India under India-Spain treaty? That is the question. So, question is that whether it has access to India-Spain treaty? Answer is yes. It is a PE in India. It is a resident of Spain, and therefore it has access to India-Spain DTAA. Now, if it has access to India-Spain DTAA, first of all, whether this income, interest income, which is being earned from Sweden, is it an interest income under India-Spain DTAA? Answer is no. So this is which income? This is income under Article 7 of India-Spain DTAA, which is taxable in India as it is attributable in the hands of the branch. So there is a taxation in India as per Article 7 of India-Spain DTAA. And thus, if it can go, whether it can go to non-discrimination article, that is an important question.
to be analyzed over here. So there is Article 26(2), non-discrimination article of India-Spain DTAA, which reads like this: the taxation on a PE which an enterprise of a contracting state, Spain, has in the other contracting state, India, shall not be less favorably levied in that other state, India, than the taxation levied on the enterprises of that other state, India, carrying on the same activities in the same circumstances or under the same conditions. So the objective of non-discrimination clause is that if there is a PE in another country, which is India in this case, in that case, okay, that PE should not be less favorably taxed as compared to the taxation which are levied in the hands of the resident of that particular country in which PE is situated. So if there was an Indian resident, if Indian resident would have earned the interest income from Sweden, then Indian resident would have got the credit under India-Sweden treaty. But because I am a PE, because I am a non-resident in India, I am earning the same interest income from Sweden, but I am not getting any credit of what taxes I have paid in Sweden, and therefore can I invoke this non-discrimination article because I don't want to be less favorably treated on taxation front as compared to Indian resident. And both there are various international commentaries which supports this contention. So Philip Baker in his commentary on Article 24 of Model Convention has mentioned like this: when a PE receives foreign income which is included in its taxable profits, it is right by virtue of the same principle to grant to the PE credit for the foreign taxes borne by such income when such credit is granted to resident enterprises under domestic laws. Also, late Professor Klaus Vogel in his commentary has mentioned that to the extent of the double taxation of the PE cannot be avoided by these tax crediting provisions, in that case, Model Convention recommends that in the treaty between the PE country and the resident country, that is in the treaty between India and Spain, a provision be included which obligates state of the PE, that is India, to credit the tax paid by the PE in third state, which is Sweden. So this supports the contention, and going by this, okay, SSC can take an argument that Indian PE should not be less favorably treated on the taxation front as compared to Indian resident, and therefore it should be granted credit of the taxes which it has paid in Sweden on the state interest income. Now the question is, if credit has to be given, credit will be given under which treaty and at what rate? So the interest taxability under India, Sweden is at 10%. However, interest taxability under Spain, Sweden is at 15%. And taxes are in fact being deducted at 15%, as we saw in the slide when we were dealing with the implications in the hands of Sweden country. So if 15% tax is deducted, can India grant credit of 15% by invocation of non-discrimination clause? Or whether Indian tax officer will say that if Indian resident would have been taxed on interest income from Sweden, okay, as per India-Sweden treaty, the tax applicable was only 10% on the interest income, and therefore doubly taxed income qualifies only this 10% income, and therefore we will grant credit only for this 10% income and not the 15% taxes that has already been paid in Sweden. So to my mind, this is how the correct argument and the correct proposition of law should be, that non-discrimination article allows the PE, which is a non-resident, to invoke the provisions to the extent of claiming the relief of FTC and not being considering as less favorably treated on taxation front. However, it will not compel the tax department of the PE country to grant the credit of the taxes which its own residents are also not getting. And therefore, in this case, taxes, foreign tax credit by Indian tax authorities may be restricted to 10%. If that is the case, now what happens at Spain level? So friends, hope you all are with me so far. Let me just summarize. Okay, so at Sweden level, it is Spain-Sweden treaty which is applicable and not India-Sweden treaty, and tax is deducted at 15%. When it comes to India, because it is an Indian branch, it is a PE in India, and therefore as per article, and say this interest income is attributable to this PE, and therefore as per article 7 of India-Spain treaty, this income is taxable in India. Thereafter, by invoking non-discrimination article, credit is claimed for taxes paid in Sweden to the extent of 10%. Now let us go and understand what happens at Spain level. Yeah, so Spain is the resident country. Okay, this company is incorporated in Spain and is a tax resident of Spain. Now, as per the provisions of Article 11 of Spain and Sweden Treaty, which is Article 11(1), interest income sourced from Sweden would be taxable in the hands of Spain company in Spain. And we also saw that as per Article 2, Sub-Article 2 of Article 11 of the same treaty, interest income secondary right is also given to the source state, which is Sweden in this case, and Sweden has deducted TDS at 15%. And therefore, the question is that if it is taxable in the Spain company because it is a country of residence, in that case, what will be that foreign tax credit eligible in the hands of the Spain company? So there could be two scenarios over here. Okay, first scenario is that if India has granted the FTC because of the virtue of invocation of non-discrimination article, and if India has not granted any FTC, that is how Spain will have to see how much credit it has to give. So first of all, by plain vanilla reading of Spain-Sweden treaty, okay, which talks about the ordinary credit of FTC, and therefore suppose the domestic tax rate in Spain is higher than 15%, then it is eligible for entire 15% tax, which Sweden has deducted at source as per Spain-Sweden treaty. This is a plain vanilla case if there was no triangular case. Now, because there is a P in India, okay, where this income is taxable, in that case, if India is also taxing that particular interest income, and as I mentioned, two scenarios, if India is giving the credit or not giving the credit, okay, depending on that, the eligibility of FTC needs to be determined at the Spain level. So if India is granting that FTC under by invoking non-discrimination article, and if it is granting, say, to the extent of 10%, then balance 5% of taxes withheld in Sweden should be eligible for credit in Spain by virtue of Article 24 of Spain-Sweden DTAA. Further, what happens if India has levied some extra tax? So say tax rate in India is say 25%, okay, say 40% for the PE, okay. So say tax rate in India is 40% on the net income basis. Interest income which India has received from Sweden has been charged to tax at 15% in Sweden on gross basis, and India gives credit only of say 10%, and India taxes balance net income on the 40%. So one will have to compute that the actual amount of tax in India, whether it is higher than that 10% credit which may be allowed in India. If yes, then that excess tax which India will levy even after granting FTC for taxes paid in Sweden, that excess tax should again be eligible for credit at the Spain level. This is what I wanted to explain on this particular slide. So Sweden can certainly claim taxes credit of taxes done. Spain can claim FTC of taxes done by Sweden. However, it will have to see, okay, that how the tax treatment and FTC has happened in India, and accordingly, the credit needs to be granted in Spain, as we discussed. So we can take another case study, which is also on a triangular case, but on a different footing. In earlier case, there was a P in India. In this case, there is a P outside India. In that case, whether you are eligible for which treaty access, that is the point which I wanted to drive over here. And I have kept the same country example so that it is very clear, why we are taking this position in this particular case. So in earlier case, there was Indian branch of a Spain company and there was a third country, Sweden. Now here, suppose there is a Sweden branch of the Spain company and say India is a third country and say India is providing FTS services to Sweden branch of that Spain company and India is receiving FTS income from that Sweden branch. Now in this case, the question is that which treaty India should apply? Whether India should apply India-Sweden treaty or whether India should apply India-Spain treaty. So answer is very clear and very simple in this case because ICO is a resident of India. It fulfills the provisions of Article 1, 3 and 4 of India-Sweden treaty. And because country of residence is India in this case, country of source is Sweden, and therefore it is eligible for concessional tax treatment of India-Sweden DTAA. And as per Article 12 of India-Sweden DTAA, FTS is taxable at 10%. And as per Article 24(2)(a) of India-Sweden DTAA, okay, foreign tax credit, okay, reads like ordinary credit mechanism. That is, income should be taxed in accordance with the provisions of the Act treaty, and it cannot exceed the tax which is attributable to the income which may be taxed in Sweden. Thus, while tax is withheld, suppose in this case, okay, Sweden does withholding on this interest income at the domestic rate of 20%, but credit in India will be applicable only for 10%, which is in accordance with Article 24(2)(a) read with Article 12 of India-Sweden DTAA. Smita, I can complete next case study in 5 minutes if you want. That is the last case study. I have 5 minutes, right?
Yeah, please go ahead. Please go ahead.
Oh, okay. So next case study is that, what happens in case of the Forex conversion and whether that is eligible for foreign tax credit. So there are many Indian MNCs who have branch as a model for operating in foreign jurisdiction and say it has, various branches. Say there is an Indian MNC which has various branches for executing overseas projects in the respective overseas jurisdiction. So as we all are aware, okay, there is a line-by-line consolidation of branch books of accounts into the head office books of accounts into India at the time of preparation of the consolidated financials of India. In this case, for consolidation when branch financials are converted into INR, okay, what treatment needs to be given on FTC on that Forex income or gain? That is the question. So when you do say branch books are prepared in foreign currency, which is applicable in the respective jurisdiction. Say in US branch, it is prepared in USD. It is prepared in some other currency in any other country. Now, when you convert each foreign country's branch accounts into India in INR, and when you compute the Forex income or Forex loss as the case may be, okay, what should be the FTC treatment? That is the question. So friends, as per the accounting standards, there are different mechanisms which are provided. One of the mechanisms says that you have to convert, Forex transactions on a daily basis. There is another mechanism which says that you have to take year-end rate and then you have to convert. So generally in practice, what I have seen in case of many of the clients is that branch books are converted on the year-end basis at the closing rate. In that case, there is a Forex income or gain which takes place. So question is whether you can claim, so say there is a royalty income, okay, which is sitting in the branch books of accounts. Okay. Now say royalty is, 100 rupees when you accounted in India. Thereafter say when you are doing the year-end consolidation, okay, and there is a Forex conversion of 20 rupees of gain. So can you say this 20 is also a doubly taxed income in accordance with the provisions of the treaty? And therefore, can you claim FTC on this? Friends, in my view, answer could be no. While the rules are silent, 128 rule is completely silent on this aspect. It only talks about conversion of foreign tax amount which you have paid in that foreign jurisdiction. It does not talk about how a transaction is to be converted, on which day is to be converted, which is the principal transaction. And in case of branch where you consolidate entire books of accounts, how that consolidation needs to be takes place, what should be the treatment, it doesn't talk about all that thing. So, and there are no direct judicial precedences, but I came across one of the Bombay High Court ruling in case of Balarpur Industries, wherein Bombay High Court has held that nature and character of foreign exchange gain or loss is different from the nature of the principal income being royalty and interest income in that case, and hence not eligible for concessional tax treatment available for royalty and interest income. This implies that foreign exchange gain or loss is a separate income itself, and it does not partake the character of the doubly taxed income, okay, which is sourced in the foreign jurisdiction, and hence, in my view, that should not be eligible for foreign tax credit. So with this, I have tried to complete my presentation in the provided time slot to me. I would like to thank all the participants for a very patient listening. And also, I would like to thank IFA once again for giving me this opportunity to present my thoughts on the foreign tax credit and practical aspects revolving around the same. Thank you.
Before I give it to hand it over back to Sushil sir, I have one last question from the participant. In case study 5, the withholding tax is not in accordance with the treaty. Earlier, you had mentioned that if withholding tax is not in accordance with the treaty, then FTC may not be available. However, in the case study, FTC is allowed up to 10% treaty rate. Can you please elaborate on this? Thanks.
Can you just say in case study 5 which particular slide?
So I think somebody has come back.
You're talking about this slide where there is a branch in foreign jurisdiction, triangular case where P is in there in foreign jurisdiction.
So I have no answer to that because
the person who has raised this question, can you give the speaking rights to that person?
No, but the person is anonymous, so I don't know.
We can ask him to raise a hand and give him opportunity.
I cannot see, sir, anybody. So anyway,
I think we can now conclude the session.
Sir, slide 2.
Okay.
Slide number 2.
Yeah.
On case study number 5.
Yeah.
Okay. Smita, can you just repeat the question?
Yeah, I'll just repeat the question.
So what I mentioned here is that, as per the facts of this case, the withholding which is done in Sweden is at 20% as per domestic law. Whereas the FTS income article as per India-Sweden treaty gives the taxation right to source country only up to 10%. And therefore, it is not in accordance with the treaty. 20% withholding which is done is not in accordance with the treaty. And therefore, I said that, you should be eligible for foreign tax credit only up to 10% and not for 20% of withholding tax which is done in the domestic country.
Thank you. Thank you so much.
Am I clear? Okay, hope I have clarified it.
Yeah, thank you so much. Very fascinating and interesting and thought-provoking session. Good food for thought for all of us during the luncheon hour. And very special thanks to you. And now I'll hand it over to for a formal vote of thanks to Sushil sir. Over to you, sir.
Thank you, Smita. Well, it is interesting to see that all the participants remained glued to the presentation all through. And I all the way, during the preparation for this presentation, I had been coaxing Monika that you are not sharing a presentation and it would remain a one-sided discussion. We would not have a good participation unless we have a prior opportunity to discuss the case studies. But I was hardly aware that she'll keep the audience glued for that longer time. And such a seesaw of provisions and great experience to learn from. So thank you so much, Monica. And I'm really grateful to all the participants, to IFA office who has organized this, and particularly Zoom, because of despite a bad weather, we are all here listening to such a beautiful talk. And when Monica is not in Delhi and our participants are there from all over the country. So thank you everyone for this wonderful talk, for this great enhancement to our knowledge. Thank you so much. We'll keep on doing such good programs in our future as well. Thank you.
So, last question for you, Monica, whether presentation will be shared, that question is repeatedly coming.
Yeah, it will be shared.
Yeah, thank you so much. Thank you.
You can circulate it to all the participants.
Yeah, we'll do it. Thank you. Thank you so much.
Sure. Thank you.
Over to you, Shelly. Please close the session.